the immediate financing arrangement and how it works for Canadians. So you have a successful and profitable business, and you're saving retained earnings each year into your holding company. Kids are good. You bought the house. Everything seems to be going fine. But you know what they say, right? More money, more problems. Now the problem is, how do I grow my retained earnings without it being subject to the highest tax bracket? How do I make sure I have liquidity for my business or for other investments that come along the way? How do I pay for retirement without a massive chunk of that going to tax? And then at the end of it all, how do I transfer this to my family and to my loved ones without, and I get to create that legacy without sending more than half of my money to Ottawa so that they can blow it on whatever they want to blow it on? If these are the problems that you're facing as a business owner in Canada, you are in the right place. So I am going to introduce you to a very specific financial concept called the immediate financing arrangement, or IFA. So my name is Laurent Munier, and I'm a partner here at Safe Pacific Financial. And we've been helping incorporated Canadian business owners and their families to grow and keep their wealth for more than a decade. Now, who is this video for? Not all financial strategies work for everybody. This is a very niche financial strategy that's designed for high net worth individuals and business owners who are in a very specific financial situation. But if you do fall into this category, if you are that person, the potential benefits of implementing this strategy could be worth hundreds of thousands or millions, and even for some of our clients, tens or hundreds of millions of dollars over their lifetime. This is not your typical life insurance policy. It's a very advanced financial strategy that combines corporate tax planning, wealth preservation, and estate planning to maximize the financial efficiency while minimizing financial risk. Now, if you're a successful entrepreneur, if you're an investor, you're a business owner, and you're looking for ways to protect and to grow your wealth, this may be an ideal situation for you. So this financial strategy, it's perfect for individuals who meet really specific criteria. So number one, you need a large amount of permanent life insurance, usually for estate planning purposes. So you have significant assets that are going to trigger a large capital gain in the future when you pass away. So this could include your company, this could include an investment portfolio, real estate holdings, or other valuable assets that are going to grow in value and eventually are going to get taxed. Without proper planning, your heirs may be forced to sell assets to cover the estate taxes, and this is something that the permanent life insurance can help to prevent. Another thing is that you want to preserve your wealth while maintaining liquidity. So many people need large amount of life insurance for estate planning, but they don't want to tie up large amounts of capital in a traditional policy. So this strategy allows you to fund the life insurance need now while keeping your business and investments running smoothly and while keeping your cash available. Another thing is you own a profitable business that has and is going to continue to have significant retained earnings, right? You're successfully running an incorporated business. You're accumulating retained earnings inside the company every year, and ideally you're pushing that to a holding company. And your annual cash flow for savings is in the 6 or 7 or 8 figure range. So you're looking for ways to maximize your after-tax wealth. Another thing too that's mandatory, you need to be at least financially savvy enough, and you need to be comfortable using debt strategically to enhance your returns and to optimize your cash flow. It doesn't work if you're a dummy, right? You need to be sophisticated enough for this thing to work. Now, instead of letting retained earnings sit inside your corporation where they may be subject to high passive investment tax rates, you can redirect these funds into a corporate-owned life insurance policy that'll grow tax deferred and provide a tax efficient payout to your estate. Another thing too is you have a growing life insurance need today and in the future. So right now, you probably already have significant financial obligations. Maybe you have young children, business partners, you've got large debts like your mortgage or commercial real estate loans or business loans. So you need the protection anyways. But in the future, your financial situation is going to be even more complex. Your assets are probably going to continue to grow in value. Your taxable estate is going to increase significantly due to capital gains. There's real estate that's growing. There's investments that are growing. So if you don't have proper planning, these future tax liabilities are going to erode your wealth. So by implementing this strategy now, you can lock in financial security, you can preserve your legacy, and you can ensure that your beneficiaries or your business partners don't face unnecessary financial stress when you pass away. So why does this immediate financing arrangement strategy work for high-income business owners in Canada? Well, many business owners don't realize that retained earnings inside a corporation can become a major tax liability over time. So instead of letting your corporate savings be taxed at high passive income rates, this strategy that I'm going to talk about today, it allows you to grow your corporate wealth tax efficiently. It allows you to leverage life insurance as a powerful financial tool. It lets you use debt to fund this whole thing without disrupting your cash flow. And it ensures that your beneficiaries or your business partners don't face a major tax burden when you pass away. The wealthiest businesses and the wealthiest business owners in Canada use corporate-owned life insurance strategies to preserve their wealth today and to pass it down to their family later, while also ensuring that they have access to the capital they need now as they continue to operate and grow their business. I'm also going to talk about right now, who is this not a good idea for? So if you are not profitable and you don't have significant cash flow to your holding company each year on a consistent basis, this is not a good idea for you. If you don't need life insurance in the first place, or you don't like life insurance, this is not a good idea for you. If you don't have kids or you don't have anyone that you want to leave a large insurance policy to in the future when you pass away, this is not a good idea for you. If you don't have a good relationship and you don't have good handle on debt, this is for sure not a good idea for you, because a large part of what makes this strategy work is debt and lending. So if you're bad at debt, don't do this. Now, what is an immediate financing arrangement, or IFA? So we'll start at the beginning. What is it, right? An IFA is building up a large cash value inside a life insurance contract and then using the cash value as collateral for a loan with a third-party lender like a bank. So we usually will hold the life insurance inside a holding company, maybe inside a trust, and then we're using the life insurance to store your retained earnings for the very long time. The big benefit of wrapping up the money inside the life insurance contract is that the whole life insurance that we're using grows over time with a dividend that's paid from the insurance company's participating account. So you get safe, stable, consistent growth of your money that's not tied to the ups and downs of a stock market. Another big benefit of wrapping up the retained earnings inside the life insurance contract is that the tax treatment of life insurance in Canada. So life insurance in Canada is considered tax exempt. The growth inside the policy is tax deferred, and the life insurance payout is tax free. This is how life insurance works in Canada. So it's a great way to grow your money in a tax efficient way. It's a great way to use your money in a tax efficient way while you're alive. And then it's a great way to pass your money down to your beneficiaries in a tax efficient way when you die. And there aren't really any other types of assets in Canada that let you do this in this way. Question we get all the time: why haven't I heard about this? This sounds great. Why has nobody told me about the IFA strategy? Well, that's really simple. There are only very, very few people in Canada that should ever be doing a strategy like this. Now, let me break this down. So Statistics Canada says there are 1.2 million businesses in Canada. If each one of those businesses is owned by one person, then only about 3% of all Canadians are business owners. Out of these 3% of people, Statistics Canada says that 68% of them are going to survive 5 years in business. So we can assume that there's some sort of profitability there for businesses that are more than 5 years old, and the ones that were gone are not profitable. So what I'm saying is, on a broad basis, only 2% of Canadians would even be able to start considering if this is a good idea for them. Now add to that these business owners should also have kids. They probably have some sort of large capital gain on death. They probably have an affinity for life insurance, and they need to be comfortable with debt and alternative financial strategies. So add up all those statistics. And basically what I'm saying is, no, there's not a lot of advertising for strategies that could only potentially be suitable for 1% or less of the population, right? It's way more profitable for companies to advertise mainstream strategies that are applicable to way more people. This is also when you see other videos telling you not to use leveraged life insurance strategies. Those videos are probably right. Most people in Canada should not be doing something like this and shouldn't even be thinking about it, right? Like the way that Stats Canada's numbers are, 98% of people should never do this. But for that 2%, for those few people that it fits with, if you're you have this profile of a profitable business owner, you have a family and you need life insurance and you like life insurance, this strategy is a no-brainer, and it's one of the only things that you can do to grow and use and pass on your money inside the holding company without a massive amount of it being sent to Ottawa in taxes so that they can blow it on whatever they want. There you go. Who's it for? Who's it not for? Now the important question, how does this thing work? So if you're here, congratulations, you're one of the 1 or 2% of profitable business owners in Canada. We are a rather small bunch. So here's the quick rundown of how one of these IFA systems works. So number one, you're going to set up a participating whole life insurance policy with one of the few Canadian insurance companies who offers the right types of policies to make this work. This is where we help you. We answer some questions like, how much do you set this thing up with? This depends on a few things, right? First, we want to make sure that you have the right amount of insurance based on your company and family needs. Then we want to look at your annual retained earnings that you're putting into your holding company each year. So we're going to use these two numbers to determine really the amount of insurance that you need and the amount of cash values that you want to build up inside the policy. We have a couple meetings to make sure that we dial this in right and that we really understand your situation and what you're trying to do. And then the next step is that we actually start to put the plan in place. Just because you want to set up a strategy like this doesn't mean that you can. You have to apply for the insurance and you have to be approved. So that means if you've got health issues or maybe you're too old, maybe you don't get approved and you can't even do this even if you want to. While the insurance application is being underwritten, we simultaneously talk to the bank about setting up the lending against the insurance policy once that insurance policy becomes approved. The bank lending that we do for this is very specialized lending, and only a very few people inside the bank know how to do this and know how to set this up. So you can't just walk into the branch and talk to the teller and get this thing set up. They're going to have no idea what you're talking about. We're generally working with either private banking or commercial lending to set up an IFA for you. And then while we're doing this, we're also in communication with your accountant and with your lawyer to make sure that the whole financial team is on board with the strategy, and also so that those guys can provide the underwriting documents and the ongoing maintenance requirements every year. And how long does this thing take to set up? That depends. It's going to be at least a couple of months. Sometimes it can take years to set these things up, depending on how organized your paperwork is. If your taxes are up to date, if you've got all your health assessments done, this may involve your doctor. I just finished setting one of these things up for myself personally, and it took about a year to get everything done. And like, this is my job. I do this all day, every day. It still took time. But this is what we do, right? This is where we hold your hand throughout the entire process and make it as smooth and painless as possible. So once the insurance is set up and the bank credit is approved, everything else after that is way more quick. So once the loan is set up, they usually set this thing up as a line of credit so you can access the money whenever you want, like within a day. When you borrow the money from the bank, there's interest due and the rates are generally favorable. So most of our clients are around prime or prime minus, prime plus, depending on your credit situation and depending on the bank's risk assessment of you. We don't decide what you're lending at. Generally, our clients are making interest-only payments on the loan, but you can pay off the principal if you want. And in very simple terms, this is what's called asset-based lending, using a life insurance policy as the asset. It's very similar to if you use real estate or a stock portfolio as collateral for lending, just minus the market risk for your stock portfolio and minus the management work and the time that it takes to manage a real estate portfolio. So you must know that if the borrower defaults on the loan, the lender can collapse the life insurance policy to recover that loan amount. But generally, the bank doesn't want to do this, and they're going to try to find a way to work with you so that you don't have to collapse the life insurance policy. We deal with most of the major banks in Canada on this strategy, and the ones that I've asked about this say that collapsing the policy to recover the loan proceeds is in the single digits of the times that they've ever done it. This is not something that they want to do. So the immediate financing arrangement, it's an advanced financial strategy. It maximizes your liquidity, it minimizes your taxes, and it enhances your wealth building potential for your business owners today. And it also leverages the permanent life insurance to provide a tax-efficient growth and estate planning benefits and ongoing financial flexibility while preserving your capital for investments and business operations, right? So it checks a lot of boxes and it does a lot of things. It's a very flexible strategy to do once you wrap your head around kind of like how it works and where the moving parts are going. So if you're looking to protect your family, your business, and your wealth while keeping your money working for you, an immediate financing arrangement or IFA can be a really powerful financial tool in your toolbox. So now let me talk about some of the major advantages. Number one, you need life insurance anyway. Life insurance is essential for both your personal and your business financial security. So with this strategy of the IFA, you get the large insurance coverage that you need without locking up your money, without locking up your capital in the high premiums. It protects your family, it protects your business partners if you have any, and it protects your estate while keeping your liquidity intact. Many successful business owners, they already recognize the importance of permanent insurance, and they want to cover their estate taxes, they need to secure business continuity, and they want to protect their financial legacy. But paying that large annual premium ties up a lot of money that could be used for growth. So the IFA solves this problem by allowing you to fund the policy using your money and then using the bank financing as liquidity so you can maintain your access to capital while you get the coverage that you need. This lets you grow the money inside your holding company while not being subject to really high taxes. So you can expand the wealth inside the holding company without triggering high corporate tax. And then the life insurance cash value inside grows tax deferred, which is a really good way to grow your investments, right? It's growing and you're not paying tax every year. Another huge one, and this is kind of new, it avoids the passive income tax rules. So these rules were introduced in 2018, and it really limits how much money you can make passively inside your holding company without really high taxes and also without reducing your small business deduction on your operating company. So that growth and not being subject to the passive income rules is actually like a massive reason why people are setting up these IFAs and why you're probably hearing way more about them today than you did before. Because under Canadian tax law, passive income over $50,000 annually can increase your taxation on your small business, and it reduces your small business deduction. And it actually reduces your small business deduction $5 for every $1 over 50,000, right? So once you hit, let me just tell you kind of how the IFA helps, right? It's because life insurance is tax exempt. So the funds growing in the policy don't count towards passive income rules. And so this allows the business to accumulate the wealth efficiently inside the policy without creating and increasing this tax liability. So instead of paying higher corporate tax, your business can use the IFA to store wealth inside this tax environment, right? Inside the life insurance policy, while keeping the funds very accessible and liquid to you through financing. And then one of the biggest advantages is the liquidity. So instead of tying up the capital inside the insurance policy, the loan lets you borrow against the policy's cash value. And this gives you money to do whatever you want, which is reinvesting in the business so you can expand, you can buy, you can start new projects, you can invest in the market. You're buying stocks or ETFs or whatever securities, buying real estate or upgrading real estate or whatever, whether that's rental properties, commercial properties, development, and funding other wealth building opportunities as they arrive. And then how does this work? So when you set up the IFA, the bank provides a loan secured by the life insurance policy cash value. So this means you can use those borrowed funds for whatever you want, investing or business, and you still keep the policy in place and the policy continues to grow. The cash values in the policy continue to grow. So many of our clients, they're using their IFA to invest in different types of assets. So you can maximize both your tax efficiency and also grow your wealth. There's also, again, because this is life insurance, there's huge estate planning benefits, right? The life insurance death benefit, number one, will cover future taxes. So the life insurance is growing over time. It provides you an increasing protection for your estate. And then when you pass away, your estate will probably owe significant capital gains. And so the policy pays out and you can use the money to pay off those taxes. It also ensures that your wealth can transfer efficiently to your heirs without liquidation of other assets. So most high net worth individuals and business owners are going to face some sort of substantial estate tax on death, especially if you still own your company, you have corporate shares, if you have an investment portfolio, if you have multiple real estate properties, if you have a privately held business or like a family business. Without doing proper planning, usually the receivers of that, the beneficiaries, are forced to sell some of these assets, which may be at an inopportune time, just to pay the taxes, right? So the IFA ensures that a significant life insurance payout happens, and then you can use that money to pay the taxes and preserve the estate, right? If your family owns these buildings and you want to keep owning those buildings, well, a good way to do that is to have life insurance pay for the capital gain when the patriarch or the matriarch passes away, so that the kids don't have to sell the buildings to pay the taxes. And then the way that works, it's a tax-free payout to your corporation and to your beneficiaries. So the life insurance pays out tax-free to your corporation, and it creates what's called a capital dividend account, or CDA. And the CDA allows that money to flow to the beneficiaries out of the corporation tax-free. So your beneficiaries will receive their inheritance tax-free, which maximizes the wealth transfer to your family. One of the most powerful estate planning benefits of the IFA is this capital dividend account, or CDA. You definitely talk to your accountant about CDA. And if you say capital dividend account to your accountant, they will love it. How does it work? How does the CDA work? So when the insurance policy pays out, the death benefit is received tax-free by the corporation. Then the insurance payout creates a CDA credit, which allows the company to distribute tax-free dividends to the heirs or to whoever the corporate beneficiaries are. So this means that your beneficiaries receive the money tax-free rather than paying significant tax on the inherited corporate assets. Like if you just transferred the company to your beneficiaries, they're in the same problem as you are. They have the money inside the company, but if they take any of it out, half of that is going to go to tax, right? So by having the money transfer through the life insurance policy instead, they're able to take the full amount without half of it being sent to Ottawa for Ottawa to choose what's best to spend your money on. Without having this structure, the corporate funds are distributed to the beneficiaries and they'll be taxed, right? So whether that's a dividend or a capital gain, or they're taking out a salary, however they want to take the money out. With the CDA, the heirs receive the full value of your wealth without half of it going to tax. So let's just have a quick example here. You have a $5 million life insurance policy inside the corporation. When you die, the $5 million pays out tax-free to the corporation. This creates $5 million of capital dividend account, or CDA, inside your company. That full $5 million can be distributed tax-free to your beneficiaries. So this ensures the maximum wealth transfer and an efficient wealth transfer, preserves your hard-earned assets for the next generation, and it allows you to distribute the money where you want, versus if you don't make a plan, half that money is going to go to Ottawa and they are going to decide where to spend your money. And generally, when I talk to business owners, they generally feel they are better at deciding where their money goes than Ottawa. If you love sending half your money to Ottawa and having them decide where to send your money, don't do this strategy. It's really bad. If you want to pay 50% tax, these videos are not for you. There are big risks to the IFA, and I'm not going to shy away from addressing those right now. Everything I talked about so far is happy unicorns, but there's also major risks to setting up a strategy like this. And the first one is you're setting up a large annual premium commitment to fund the life insurance policy. So don't get into something like this without the certainty of having those annual premium deposits each year, or a big lump sum now that we can use to fund the policy over a couple of years. There's also commitment risk, right? We're using a whole life insurance policy in this case to build up the cash value and as the asset that's going to secure your lending. So as the name says, it's whole life insurance. It's for your entire life. So this is a strategy that you're setting up today for 30 years, 40 years, 50 years. This is not a short-term strategy. This is not something that you're looking at to set it up and you're looking at it 1 or 2 years in the future. You're looking at this thing for 10, 20, 30, 40, 50 years into the future. You're literally setting this thing up for the rest of your life. So, some people like me really like this. Other people really don't like the long-term commitment. If you don't like long-term commitment, then this strategy is not a good idea for you. There's interest risk. Because you're using borrowing from a bank to provide the liquidity, there's interest payable on that. You got to pay the bank. And then as you borrow more each year, the loan gets bigger each year. So your interest payments grow. Because you're borrowing, changing interest rates over time are going to affect your strategy here. So we know what the interests are today, but we don't know what the interest is going to be tomorrow or next year or the year after that. So what we do know for sure is that interest rates go up and interest rates go down. They change over time. So there are potential implications for that. There are also potential tax implications here. So while the loan itself is not taxable, there may be tax consequences if you cancel or lapse the policy, which we totally suggest you do not do. There's also annual maintenance that you need to do on the actual life insurance policy. So there's life insurance policy maintenance. You need to keep track of it on your taxes and you need to update the bankers on this, right? So you need to work with somebody who knows what they're doing. You need to work with somebody who knows how to do this and somebody who's going to be doing this every year for you, because there is service that needs to happen on these policies. The communication also needs to happen with your accountant, with your lawyer. We need your corporate documents. We need to communicate with the bank. We need to communicate with the insurance company. And all of these people need to be updated at least once a year, sometimes a couple of times a year, depending on when your year end is. So like I said at the very beginning, this strategy is probably only good for about 1% of all Canadians. But in that same vein, only about 1% of financial advisors should be talking about and implementing this strategy for you. It is very, very, very important that you work with somebody who knows what they're doing when it comes to an immediate financing arrangement, and somebody who has the capacity to service you and your business for many years to come as you use this strategy in your life. Do not work with somebody who doesn't do IFAs all the time, because there are a lot of moving parts and a lot of things that can go wrong if you don't do it right. And if you're working with an advisor that doesn't really know what they're doing, they can kind of hide that they don't know what they're doing for a long period of time before you figure it out, and it might cost you a lot to fix. So just, upfront, work with somebody whose job it is to do this and who does this all the time and who has experience. Then you have your legacy and estate planning benefits. So one of the biggest reasons that you set this thing up is for the estate plan, right? So most of our clients have a growing business. They also have other investments. They probably also have real estate holdings. All of these things are usually expected to grow over time, over their life. And what does that mean? Well, it means they're going to have a very large tax bill or a capital gain bill when they die. Well, actually, they won't. Whoever their beneficiaries are will. So let's say you have a company today that's worth $3 million, and you have a house that's worth $2 million, and you have $1 million in a portfolio somewhere. So for very, very simple math, let's say that whole thing grows at 5% a year. And today you're 60 and you're going to die at 90 in 30 years. So this grows your total net worth to about $21 million on death. And your estate would have to be able to pay that capital gain, which at today's rates is around $8 million. So if that happens right now, they would have to pay 50% tax on that. So $4 million in taxes would be due in the year that you die. Do your kids have an extra $4 million kicking around to pay taxes? This is a very simplistic example, and I know the accountants that are watching this probably have all sorts of planning things they can do to save taxes and protect wealth, but this is just a very, very simple way to illustrate a point of how quickly your tax bill can grow and how big it can become over your lifetime. How are your kids, or how is your estate going to come up with $4 million in this example to pay your taxes that year? The IFA strategy gives you a large life insurance payout within a couple of weeks of death to use that money to pay the giant tax bill that comes due. The IFA strategy and the creation of the capital dividend account, which we're going to talk more about in a minute, also lets you leave a large inheritance to your heirs after all of these taxes and after all the loans and after all the interests are paid. So really, when you set this kind of strategy up for yourself, for your business and your family, you're also guaranteeing a legacy to your family. Now we'll talk about the impact of the capital dividend account. So we just talked about it a little bit, but really, what is it? So the CDA, it's a tax account that tracks tax-free surpluses inside a corporation. So generally, this is created by the receipt of a capital dividend, and it's also created by life insurance payouts. So the money inside a CDA can flow to the beneficiaries of the company tax-free. So after the life insurance pays out, the proceeds are used to pay off any loans to the bank, and then the remainder can pay out to your company shareholders or beneficiaries tax-free. So we would suggest that those beneficiaries are usually going to be your family or your kids. So this is a way to get tax-free money to your kids from your business. So in conclusion, and this video is getting a little long, so I'm going to wrap it up. We talked about the problems that successful business owners in Canada have in terms of growing their money, in terms of using their money without being subject to high taxes every time they turn around. We talked about who should and who should not do this strategy, and really like how few people in Canada this actually makes sense for. It's a very small percentage of people that should ever even think about this. Then I also gave you a quick rundown on what is the IFA, how does it work, and talked about, why you've probably never heard of this strategy before. And we talked about the major advantages and the risks of setting up a strategy like this for yourself and for your company, and then what type of person, what type of advisor you should look for when setting something up like this for yourself. And then at the end, we talked about the major legacy and estate planning benefits of setting up a strategy like this for yourself, for your family, for your business, and then how the insurance that pays out to a corporation creates a capital dividend account that can be used to pay out to your beneficiaries in a tax-free way. And then now I'm going to emphasize again here that you only really want to work with a trusted professional that knows what they're doing and is in it for the long term. If you're looking at setting up an immediate financing arrangement, these are the only type of people that you want to work with. So if you want to work with us, reach out to us by going to our website. That's safepacific.com. Fill out the contact form there. Somebody on the team is going to get back to you within 24 hours on business days. And then we'll set up a time to meet. We're licensed across Canada. We meet clients all across the country. Most of our meetings are via Zoom right now. If you're in Vancouver, we can meet in person. But first step is really that first meeting where we can get a good understanding of your current situation and about your goals and what you're trying to do. We also want to really understand your corporate structure. We want to understand like your org chart, like, which companies owns which. Do you have a trust? How many people in your family? What are you trying to do? And all of that starts at our initial discovery meeting, which you can book on our website, safepacific.com. Now, if you got some value from this today, please add a little value back into the video. The way you do that is you click like, you click a comment below, or you subscribe, or you click share. Basically, the robots want to see you interact with this video somehow. So click on something so that they know to send this video to more of the very small amount of profitable Canadian business owners that should see this video, because they're hard to find because there's not a lot of them. That's it for me. I'll see you next time.